Fed Rate Cut 2025. Why cut despite inflation? Dual mandate explained. Bloomberg guide. Hey everyone, welcome back to the channel. If you're searching Fed Rate Cut 2025 why or FOMC interest rate cut inflation, this video has your complete breakdown. From Bloomberg's explainer, the Federal Reserve slashed rates by 25 basis points on September 17, 2025, the first since December 2024, despite lingering inflation worries. It's a balancing act of the Fed's dual mandate, stable prices and maximum employment. If you're an investor or economy watcher, subscribe and comment. Cut too soon or just right? Let's unpack the reasons, data, risks, and what it means for your money, starting now. The cut is a strategic pivot. The FOMC dropped the federal funds rate to 4.75 to 5%, signaling 2 more reductions by year-end. This aggressive move addresses a cooling economy, but inflation hovers at 2.5%, above the 2% target. Bloomberg explains it's the Fed's dual mandate from 1977, promote price stability and maximum employment, versus 2024's hikes to tame post-pandemic inflation. 2025's easing focuses on jobs. Tip: check the FOMC statement on federalreserve.gov. It's your roadmap. Viewer hook: imagine cheaper loans boosting your life. Pause and picture that mortgage drop. What's your first win from this cut? Reasons for the cut boiled down to employment. Unemployment ticked to 4.2%, with August adding just 142,000 jobs, below expectations. Revision slashed 818,000 prior jobs, painting a weaker picture. The Fed prioritizes maximum employment, cutting rates to spur hiring by lowering borrowing costs. Bloomberg notes, when unemployment rises, the Fed cuts rates to encourage spending and investment. Versus inflation stickiness, jobs data screamed action. Pro tip: track BLS monthly reports. They drive Fed calls. Retention question: employment or inflation, which mandate worries you more? Share below. Inflation context is tricky. PPI fell 0.1% in August, but rose 2.6% yearly. Cooling but not dead. Tariffs from the Trump admin risk hiking import costs, disrupting supply chains. The Fed's dilemma: cut to aid jobs or hold to fight tariff inflation. Bloomberg: the balancing act highlights the tension between maintaining price stability and addressing potential job market weaknesses. Versus 2024's 3% CPI, 2025's 2.5% feels fragile. Fun fact: the dual mandate from the 1977 Federal Reserve Reform Act keeps the Fed accountable to Congress. Viewer question: tariffs or jobs? Which FOMC worry keeps you up? Risks of cutting too soon. Lower rates could reignite inflation if tariffs pass costs to consumers, curbing growth. Bloomberg warns, this could complicate the Fed's efforts to achieve price stability, especially if economic conditions shift unexpectedly. Overstimulating a hot economy risks bubbles. Versus 2020's emergency cuts, 2025's is measured but bold. Pro tip: watch 10-year Treasury yields. Under 4% signals more easing. Retention hook: picture inflation spiking post-cut. Pause and envision the headlines. Ready for the next FOMC? What it means for you. Cheaper loans for homes. Rates of 6%. Cars and credit refine now. Stocks rally. S&P up 1.2%. NASDAQ 1.5%. Dollar weakens, boosting exports. For investors, growth stocks like tech soar. Versus savers, lower yields hurt CDs. Quote from Goldman Sachs' David Miracle, that a plot might signal 2 cuts for the rest of 2025, not 3. Pro tip: adjust your portfolio. Tilt to equities. Viewer question: rate cut for mortgage or stocks, which benefits you first? In summary, the Fed's 25 BPS cut balances jobs and inflation. Watch for tariff twists. Bullish for growth? Who's refined? Like if this guide clarified the chaos. Sub for market tips. Share. Thanks. Money moves away.